And I'm not a big technical guy. I mean, I'm very good at it, but it's just a tool. It isn't, it isn't perfect. I think we could see gold under 2,000. I think it's more for psychological reasons that the mainstream press can say, "Oh, see, gold's under 2,000." No, 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 no. I don't see it going down a lot below that level. I just think it's going to be a good year for both metals. There aren't a lot of places to go. Real estate market, commercial side looks horrible. Even the residential side doesn't look that strong. Rents are frozen in some areas, but everybody's got to have a place to live. The equity market's still overvalued. The reason that I've devoted my life to this is because it's mathematically impossible for a fiat debt-based monetary system not to fail. And of course, a lot of people go to the extreme and say, well, that means the dollar's worth zero. I don't think we're ever going to get a zero worth dollar, but its trend is definitely there. The $1913 worth about 2 cents.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day. Gold's trajectory is captivating, with the prospect of dipping below $2,000 looming for psychological reasons. However, David Morgan contends that a significant downturn is unlikely. J.P. Morgan projects a different narrative, attributing the forecasted surge in gold prices by 2024 to the combination of declining U.S. real yields and a Federal Reserve cutting cycle. The synergy of these factors is poised to propel gold to new nominal highs. In tandem with gold, silver is anticipated to mirror this trajectory, with an average price of around $30 per ounce in the fourth quarter. This parallel trend suggests a synchronized movement in precious metal markets, underlining the intrinsic link between gold and silver prices. Adding a voice to the optimism, David Morgan champions gold and silver as safer havens compared to real estate and equity markets. This endorsement positions these precious metals as not only lucrative investments, but also as reliable shelters amidst the uncertainties of other financial realms.
But no, the end game, I don't know. What I do know is what they want, and we talk about this almost every show, and that is they want to implement a new system. And then how do you get to the new system? Well, the first thing is the narrative. What story do you tell everybody so it's not the bank's fault and everybody wants to keep their confidence in the banking system? So you have to come up with a good story, which could be like a cyber attack, for example. And then you tag it with whatever, enemy de jure there is. The Ministry of Truth comes out and says, oh, it's the Russians. Well, wait a minute, we used the Russians too many times. It was the Chinese, or it was a rogue state in, the Middle East, whatever. I mean, who knows what they'll come up with. Could be a false flag, meaning that it is a true cyber attack, but it isn't actually done by anybody that's named and pointed out or made the victim. It could be someone, I'd say, but someone within the confines of the banking structure, or let's say the system. This is really important. No, there's no way out of this mess. Something's got to give. And we just don't know what that looks like. I mean, do all the debts that exist go away because they can't find them on a computer anymore? Do just certain debts go away, like government debt goes away, but your household debt for your mortgage and your car loan stay in place? Your school loan still stays in place? It's a very precarious situation. In a debt jubilee, all debts are forgiven. I mean, I think most people that learn what's really going on should save in real money. And if you do it on a longer term basis, you'll come out ahead. In other words, if you dollar cost average over the last 20, 23 years from the beginning of this bull market, gold was at 252, now it's at 2,000. Silver is under 5, and now it's at 23. So they're both up. So gold has outperformed silver at this point in time.
David Morgan asserts the seemingly inescapable mathematical reality of its eventual failure. The foundation of this belief lies in the inherent nature of fiat currency, which is essentially created through debt. Over time, the accumulation of debt within the system reaches a point where servicing it becomes unsustainable. Transitioning from the acknowledgement of the system's limitations, the focus shifts to the critical role of narrative building in implementing a new monetary paradigm. Constructing a compelling narrative becomes not just a strategic approach but a crucial component in shaping public perception and garnering support for the proposed change. Enter the influence of impactful events or stories, such as a cyber attack, which can be strategically woven into the narrative building process. These events serve as catalysts, steering public sentiment and reinforcing the urgency for a transition to a new monetary system. By integrating these elements into a cohesive narrative, proponents of change can effectively communicate the necessity of abandoning the current fiat system in favor of a more sustainable and resilient alternative. As we navigate the intricacies of monetary systems, the amalgamation of mathematical realities and strategic narrative building emerges as a potent force in shaping the future of our economic landscape.
So I think that's the approach. And then, things get rearranged. It's hard to say what the authorities will do as far as payment goes. So, for example, my favorite gold company was $30 when gold was at 2,000 12 years ago. Now that stock's at 100, so it's up 300 something percent, and gold is the same price. So if you put your 10,000 gold in the year 2011 September, it's worth 2,000 now. But if you put it into my top pick for a gold company, it'd be worth 6,000. And then I looked at my favorite silver pick, and it did about it doubled. And that is really remarkable when you think of this silver company that's doubled from the time that silver was at $50, because we're less than half of that now, and yet the price has doubled. So if you bought silver at the top of the market at 50, right now you've lost 50%. But if you bought that stock at the top of the market, right now that $1,000 investments were 2,000. So if you know what you're doing, picking, the miners or the resource sector, you can beat the market. And I just want to make that clear. I know I'm kind of touting my own word, but it's the truth, and it works. And that's why I think you should have a balance between physical metal and the equity side if you know what you're doing. And those numbers are facts. They're not made up. They're not wishful thinking. The problem is it's almost too simple. And once people learn that from me, say, oh, it can't be that easy. So they're always looking for that mother lode, right? That little stock that's 12 cents, it's going to go to $120, and they're going to buy their own island, And that happens, but not very often.
David Morgan emphasizes the potential for market outperformance through judicious selection of mining or resource sector stocks. Careful consideration of individual companies within the gold and silver sector can yield returns that transcend broader market trends. This nuanced approach invites investors to discern opportunities within the dynamic landscape of precious metal equities. Evidence underscores the viability of this strategy, as examples abound where gold and silver company stocks have exhibited outperformance relative to the underlying metal prices. These instances illuminate the potential for savvy stock selection to amplify returns, offering a compelling rationale for active engagement in the equities of companies operating within the precious metal sector. The synthesis of physical holdings and strategic equity choices emerges as a formidable strategy, bridging the tangible allure of metals with the dynamic growth potential inherent in select company stocks.
On the unrealized losses, the key word, of course, is unrealized. So that means that if these banks had to cash out their long-dated securities, you see that's in the dark blue or black, depending on your screen. And in some cases, it looks like it's almost 50% or close to it of the bank's total holdings. So that's very, very concerning for the whole banking system, because they're all interconnected. And yet the other chart shows that their net income is actually pretty stable, and it doesn't show much real loss. So the way you reconcile it is this. So the reason there's the unrealized losses, we'll just go over the basics here, is because interest rates have been increased. So those 30-year treasuries, those long-dated bonds, even a 10-year note, have decreased in value. So if you had to sell them now, you'd be selling them at a loss, and you can see the losses are substantial. And that has been done. And yet you get a net income, which is like a real head scratcher. The reason it is the way it is that the Federal Reserve said, okay, here's what we'll do. We will let you put up your securities, whatever they are, whatever the maturity is, and we'll loan you the face value. So you don't have to take a loss immediately. You're getting a loan. So if you had a house that was worth $100,000 and had a big market crash, and the house is now worth 70,000. And your banker was really, helpful to you. And he said, what I'll do, Elijah, is I'm going to give you the old value of 2 years ago. I'll give you the 100,000, but it's only for 1 year. And 1 year from now, you've got to pay me back. So that's how you can have all this net income, is that because the banking system has been drained of liquidity as far as ready cash. Cash deposits have all moved into money market funds, which means the banks are even more insolvent, yet their net income looks good. Well, why is that? Because they get to play the spread. So you get to get all this, I'll call it free funny money, and you borrow it at X and you loan it at a point higher, and you're making that spread in your direction. So of course your income looks good temporarily. Now, when the call comes, literally it's called a call loan, and they call and say, Elijah, the year's up, worth 100 grand. These banks, will they pay it? Can they pay it? Or whatever. The other thing that most people don't ever talk about in a fractional reserve system is how really convoluted it is on interest rates. You don't really ever delve into this part of the equation very often, or at least I haven't heard it very often. So if I only have to have a 1 to 10 ratio, so if you deposit $100, all I have to put on account is 10 ready cash, and I get the other 90% to loan. Instead of getting 1% on the $100, I've got 1% on the 9, but it's loaned out again and again and again, so that 1% goes to my bank, and then I send it to another bank, and they get 1% on the $80, and then the next bank gets it on. So you're really getting like a 10% yield on a 1%, if that's the going rate, let's say, loan, because you've spread that money out 10 times. Of course, it's decreased slightly all the way down from, you have to hold $10, so you loan 90, so 90, you have to keep 90 and have 81, and on and on. Do the arithmetic. But I don't think people think about those multiples, because the system is so leveraged or geared, as the Brits say, that it goes both directions. And that's why those bond unrealized losses are so huge. So